Whenever the economy starts to contract, it seems like real estate is a leading problem in that contraction or a piece of collateral damage in the fallout of a recession. In general, that makes sense. When you have businesses that are going out of business, they no longer need their physical store presence or factory presence, and that land essentially gets freed up. And in the case of people, unfortunately, sometimes they lose their jobs and are not able to make mortgage payments, and their homes get foreclosed on. And in both of those cases, you have sort of this excess of land that goes back into the market, and you generally have less demand for it. So those prices fall and the market overall for real estate kind of softens. During the 2008 Great Financial Crisis, real estate played a big impact in that. You had these really loose lending standards that allowed a lot of individuals to purchase homes and real estate that they could not afford. And ultimately, when those loans started to default, that really triggered a lot of other problems in the financial sector and the greater economy. Fast forward to 2023, we are not yet in a recession, but a lot of people have concerns about a contracting business cycle. And one of the concerns, again, is a leading indicator of real estate. This time, we are more focused on commercial real estate, whereas 2008, I think it was more focused around residential real estate. Lately, there has been some data coming out indicating that there might be some vulnerabilities within the commercial real estate sector. The Federal Reserve has been talking about it, as well as sort of industry analysts. So I just kind of want to go through some of that data and tell you what I'm seeing there, what might be concerning, and what maybe not yet is a problem, and just sort of provide some general context and story around what I'm seeing with the real estate sector at this point. Commercial real estate is a massive business comprising of $3.1 trillion in outstanding commercial real estate loans in the United States. That sector of commercial real estate loans covers a wide swath of different businesses. So you have offices, retail, apartments and rentals, and factories. All of those kind of fall under the commercial real estate umbrella. The area where people are concerned is the office building sector. Office building vacancy rates rose to record highs in late 2022 to about 18.2%, with vacancy rates of greater than 20% in Manhattan, Silicon Valley, and Atlanta, these major metropolitan areas. And that makes sense. We had the pandemic and sort of the remote work options, the hybrid work options come into play, and people have changed the way that they've worked in offices, and as a result, needed less office space in these city markets. As vacancies rise, that can be a problem for commercial real estate developers because they are collecting less rent and the value of their properties will become lower because they have less people in demand for that space. This becomes a problem for commercial real estate developers looking to finance or refinance their commercial real estate loans. They operate differently than a home mortgage would. Traditionally, they are a shorter time period, somewhere between 5 to 20 years, as opposed to kind of that standard 30 or maybe 15-year fixed mortgage for a residential home. And oftentimes, the loan is amortized for a period longer than the term of the loan. And what I mean by that is, say a commercial real estate loan is set up for a 10-year period. Well, often that will be amortized over maybe 30 years. So they will make interest payments for that 10-year period. And then at the end, they will make one large sort of lump sum payment to pay off the rest of the loan. When the loan matures, the developer can refinance or renew the loan, or they can sell off the property to cover that sort of final payment that they owe. Now, when they go to refinance, the value of the property is reappraised. And the way that commercial real estate most commonly does it is something called the net operating income approach, which essentially looks at the income that the property could generate under the market conditions that exist at the moment of the valuation. Now you're starting to see why it's a problem that there are record high vacancy rates, because if these properties are valued at a lot less than what they currently are, the developer may not be able to secure refinancing loans. They may have to sell the properties or default on them, which could trigger, further losses in the real estate market as supply greatly outpaces demand. If you find the value of this video to be greater than that of those commercial real estate loans, then please hit the like button. It does help the channel out a lot. So getting back to the data, we see that approximately 25% of mortgages on office buildings must be refinanced in 2023, which is a pretty large chunk. And of course, beyond those just conditions of maybe lower valuations on the properties themselves, the interest rates that they will face are now going to be a lot higher because of the Federal Reserve's fight against inflation over the last year and a half. In early May, the Federal Reserve came out with their financial stability report, which highlights these commercial real estate risks. And there are two main things I see from this. The first being that smaller regional banks hold about 43% of total commercial real estate loans that are outstanding. That is a concern because people are already worried about regional banks. We've had the collapse of Silicon Valley Bank, First Republic Bank, Signature Bank. Now, the collapse of those banks wasn't necessarily due to commercial real estate loans, so I'm not trying to imply that. But what I am saying is that people are already worried about small regional banks, which are holding these commercial real estate assets, could spell trouble for them in the future. Now, keep in mind that offices are a small portion of commercial real estate assets that are held by banks, but the Federal Reserve calls out that those mortgages represent 20% of total assets for these smaller regional banks. And of course, some will have more exposure than others. That's just sort of the average that we're seeing. The blind spot that the Federal Reserve calls out around these commercial real estate loans is the fact that approximately 39% are held by non-bank entities. And that leaves a large blind spot because the Fed does not know how those loans are performing that are held by these other entities. The Federal Reserve also released the quarterly survey results of loan officers, and the big takeaway there is that banks are reporting tighter standards and weaker demand for all commercial real estate loan categories. The reasons for those changing standards are cited by banks as sort of less favorable and more uncertain economic outlook, reduced tolerance for risk at this time, deterioration in collateral values, and concern about banks' funding costs and liquidity positions given the recent bank failures in Q1. So commercial real estate is starting to show some cracks as the business cycle tightens. But to be holistic, I do want to cover a few reasons I found on why commercial real estate isn't a large problem at this point. And that is mainly that the office sector is only one part of commercial real estate. And when we look at the data on the other sectors, they are relatively in pretty good shape. Retail vacancy is a lot lower at 5.7%. Apartment and rental vacancies are about the same at about 5.8%. And hotels are doing really well post-COVID. They have had really high record revenue per room as occupancy and prices have gone up during this post-COVID world. Lastly, to date, we haven't seen virtually any losses on commercial real estate yet. Delinquencies are pretty low at this point. Of course, they are low until they are not, right? So The cracks may be there, and it'll just be interesting to see how this all plays out in the coming weeks and months and rest of the year. Let me know in the comments below what you think is going to happen, or if you think it's a concern or not. I'd love to hear your thoughts. Thanks for watching.